Hello everyone, this is Dr. Zhao. In this video, you will learn Supplier Analysis 2, a financial health analysis to understand individual suppliers' financial stability, liabilities, and risk. For critical components, you need a long-term supplier. So, you need your suppliers to have a rock-solid financial health or stability. The major trap to avoid is the short-term good deal. For example, in the form of deep discount from companies with poor financial health, which can lead to a long-term crisis. One example is Evergrande, the #1 real estate company in China. As of April 2022, it carries a debt of nearly $300 billion and is deemed to be in default after missing payments late in year 2021. To save itself, the company is offering deep discount in selling its existing and off-plan housing. However, it is not wise to buy these apartments, especially the off-plan housing, despite the discount, because of the company's financial instability, as it may never complete the apartments. Returning to the semiconductor suppliers for iPhone, let's look at their financial health indicators, such as current ratio and quick ratio for short-term risk, liability asset ratio for long-term risk, and the operating cash net income ratio for cash flow from operating activities. We can see that they all look healthy in the short term because their current and quick ratios are all greater than 1. Even GlobalFoundries is healthy despite its recent losses. They also all look healthy in the long term because their liability asset ratio is smaller than 1. That is, their inverse of the liability asset ratios are greater than 1, except Qualcomm, which is close to 1, indicating some long-term risk. Except for GlobalFoundries, which had a negative net income, all made good cash flow from operations, as the operating cash net income ratio are greater than 1. Cash flows from operations are preferred to those from investment and financing. Breaking down these companies' total assets by liabilities and stockholder equity, we can see that TSMC has the highest percentage of equity and lowest percentage of total liabilities. Qualcomm has significantly more non-current liabilities than other suppliers. Intel is very healthy on equity and liabilities, with equity being more than 50% of the total assets. Despite losing money, GlobalFoundries is also very healthy in terms of equity and liabilities. And breaking down their assets into details, we find that TSMC has the highest cash and second largest property, plants, and equipment, which implies high production capacity and responsiveness. Intel has a decent production capacity, but may run a little low on cash. Qualcomm has surprisingly low property, plants, and equipment, putting its production capacity and responsiveness at question. GlobalFoundries has the highest property, plants, and equipment. It has been building up a strong production capacity. The company also had a good amount of cash. The trend analysis reveals this company's financial health over time. We can see that over the recent years, TSMC, Samsung, Intel, and GlobalFoundries had little short-term and long-term risks, and thus excellent financial health and stability. While Qualcomm is fine on short-term risks, its liability asset ratio and long-term debt ratio upswinged quite significantly in recent years, almost to the danger zone in 2018. The good news is that after 2018, the situation became less severe for Qualcomm. To recap, we can assess the supplier's financial health and stability by looking at their cash, short-term risk, such as current ratio and quick ratio, long-term risk, such as liability asset ratio and long-term debt ratio, production capacity, such as property, plant, and equipment, And finally, operating cash flow.